Hey everyone, welcome back to the Wealth Insight Collective channel. Today we're talking about one of the most important decisions you can make in your financial life, investing. If you've ever wondered, how do I start investing? What should I focus on in 2024? And where should I put my money to build long-term wealth? Then stick around, because this video is for you. By the end of this video, you'll have a clear roadmap of what to do if you're starting your investment journey in 2024. We'll break it down step by step, covering the most important things you need to know, from building a solid foundation to advanced strategies that can grow your wealth over time. So grab a notebook, settle in, and let's get started. Now, let's talk about why investing in 2024 is such a big deal. The financial world is changing rapidly. Over the past few years, we've seen everything from a global pandemic to inflation spikes, major technological advancements, and changes in interest rates. All of these factors make 2024 a crucial year to get into investing. In 2024, there are some key trends that are creating opportunities for new investors. For example, the growth of artificial intelligence and renewable energy sectors, and the continued rise of digital finance. But there's also economic uncertainty, with discussions around potential recessions and interest rate hikes. This mix of opportunity and risk means that right now is the perfect time to learn about investing so you can make informed decisions going forward. Before we dive into specific investment strategies, let's talk about something super important: your financial foundation. A lot of new investors make the mistake of jumping into the stock market without making sure they're financially secure first. So, if I were starting to invest in 2024, the first thing I'd do is make sure my financial house is in order. Here's what I mean by that. Before you invest, you want to make sure you have three key things in place. 1. An emergency fund. Ideally, you should have 3 to 6 months' worth of living expenses saved in an easily accessible account, like a high-yield savings account. This fund is there for emergencies like medical bills, car repairs, or job loss, so you're not forced to sell your investments during a market downturn. 2. Debt management. High-interest debt is the enemy of wealth building. If you have credit card debt with high interest rates, let's say anything over 10 to 12%, focus on paying that off before putting a lot of money into investments. Why? Because your investments might earn you 8 to 10% annually, but if your debt is costing you 20% in interest, you're losing money. 3. Budget and cash flow. Finally, make sure you have a solid budget and know how much you can afford to invest every month. I always recommend starting with an amount you're comfortable with and then gradually increasing it over time. Once you have these three pieces in place, you're ready to start investing with confidence, knowing that you've got a strong financial base to support you. All right, now that you've got your foundation set, let's talk about where to invest your money. In 2024, there are a lot of options, but the key is choosing the right account for your financial goals. Here are a few of the most common types of investment accounts you should consider. 1. 401k. If you're employed and your company offers a 401k with a match, this is usually the first place you want to invest. Why? Because it's free money. If your company matches, say, 3% of your salary, that's an instant 100% return on your contributions. Plus, 401ks offer tax-deferred growth, meaning you won't pay taxes until you withdraw the money in retirement. 2. Roth IRA. A Roth IRA is one of my favorite accounts for beginners because it allows your money to grow tax-free. You contribute after-tax dollars, but then your investments grow without being taxed, and you won't owe any taxes when you withdraw the money in retirement. If I was starting to invest in 2024, I'd definitely open a Roth IRA and max out my contributions, which is $6,500 for 2024. 3. Taxable brokerage account. Once you've maxed out your retirement accounts, or if you want more flexibility with your investments, a taxable brokerage account is another great option. With these accounts, you can invest in stocks, ETFs, and mutual funds and withdraw money whenever you need it. Just remember, you'll pay taxes on your gains. The key here is to focus on retirement accounts like the 401k and Roth IRA first, because they offer tax advantages, then move on to taxable accounts once you've maxed those out. If you're unsure about which account is right for you, consult with a financial advisor or use online tools to help you decide. Next, let's talk about diversification. One of the most important rules in investing is to never put all your eggs in one basket. That means spreading your money across different types of assets to reduce risk. When you diversify, you're protecting yourself from the ups and downs of any single investment. For example, if you only invest in tech stocks and the tech sector has a bad year, your entire portfolio takes a hit. But if you spread your money across sectors like healthcare, real estate, and energy, you reduce the impact of one industry underperforming. Let me give you an example of a diversified portfolio. If I were starting in 2024, I'd build something like this. 60% stocks. This can include large cap companies like Apple and Microsoft, some international exposure, and maybe a bit of small cap stocks for growth potential. 30% bonds. Bonds are a safer investment, providing a cushion when the stock market is volatile. In 2024, with interest rates expected to remain elevated, bonds could be a solid part of a balanced portfolio. 10% alternatives. This could include things like real estate investment trusts, REITs, or commodities like gold or silver. The exact percentages will depend on your risk tolerance and investment goals, but the idea is to mix it up. That way, you're not relying on any one stock or sector to carry your portfolio. And don't forget, you can achieve diversification easily through low-cost index funds or ETFs. Here's a big one. Focus on long-term investing. One of the most common mistakes new investors make is trying to time the market. They try to buy low and sell high, but in reality, no one knows for sure when the market will go up or down. Even the best investors in the world can't predict short-term market movements with accuracy. What you want to focus on instead is time in the market. That means staying invested for the long haul. Historically, the stock market has returned around 7 to 10% annually over long periods of time, and the key to capturing those gains is to remain patient and avoid making emotional decisions when the market gets rocky. Let's say you invest $1,000 in an index fund in 2024. If the market goes down 10% in the first year, that might feel scary, but the worst thing you can do is panic and sell. Why? Because if you leave it in the market and stay invested, historically, those losses tend to recover over time, and then some. Over 20 to 30 years, that $1,000 can grow significantly due to the power of compound interest. In fact, if the stock market returns an average of 8% per year, your $1,000 investment could grow to over $4,600 in 20 years, without you doing anything else. So what's the takeaway? The stock market is volatile in the short term, but in the long term, it tends to go up. Don't get caught up in the daily or monthly market swings. Focus on the big picture and stay invested for the long haul. Remember, time in the market beats timing the market every time. Now let's talk about one of the most straightforward and powerful ways to invest in 2024, low-cost index funds and ETFs. If I was starting my investment journey this year, these would definitely be my go-to investments. Here's why. Index funds and ETFs allow you to invest in a broad range of stocks or bonds without having to pick individual companies. They track an entire market index, like the S&P 500, which includes the 500 largest companies in the US. This means your investment is automatically diversified and you're benefiting from the overall growth of the market. What's even better is that index funds and ETFs have very low fees, especially compared to actively managed funds. Over time, those lower fees can save you a ton of money. For example, a fund with a 0.05% expense ratio will take much less out of your returns than a fund with a 1% fee. Let's say you invest in the S&P 500 through a low-cost ETF like VOO or SPY. By investing in one fund, you're essentially owning a small portion of all 500 companies in the index, from giants like Apple and Amazon to other major players in various industries. As those companies grow, so does your investment. Plus, you don't have to worry about trying to pick individual stocks or constantly monitor the market. This strategy has been tried and tested, and it's one of the easiest ways to build wealth over time. If you want a hands-off approach that offers solid returns, low-cost index funds and ETFs are the way to go. All right, let's talk about one of the easiest ways to stay consistent with your investing: automation and dollar-cost averaging. These two strategies are essential, especially if you're just starting in 2024. First, let's break down dollar-cost averaging. This is the practice of investing a fixed amount of money on a regular basis, no matter what the market is doing. For example, you might decide to invest $200 every month in an index fund, regardless of whether the market is up or down. Why does this work? Because over time, you're buying more shares when prices are low and fewer shares when prices are high, which can help lower your overall cost and reduce the risk of investing a lump sum at the wrong time. Let's say the market dips in March, but because you're investing the same amount every month, you end up buying more shares at a lower price. Then, when the market rebounds later in the year, your earlier investments at the lower price are now worth more. It's a way to take the guesswork out of investing and smooth out the bumps in the road. Now combine dollar-cost averaging with automation. Set up automatic transfers from your checking account to your investment account every month. This takes the emotion out of investing and makes sure you're consistently contributing to your portfolio, no matter how busy life gets. In 2024, with so many distractions and market volatility, automation is your best friend. It ensures that you're sticking to your plan and building wealth consistently over time. Now let's talk about the power of reinvesting dividends. If I were starting my investment journey in 2024, one of the most powerful tools I'd use is compounding, and reinvesting dividends is a key part of that. When you invest in stocks, ETFs, or index funds, many of them pay dividends, which are a portion of the company's profits distributed to shareholders. Instead of taking those dividends as cash, reinvesting them allows you to buy more shares of the stock or fund, which means those shares can generate even more dividends in the future. This creates a compounding effect where your investment grows faster over time. Albert Einstein once called compound interest the eighth wonder of the world, and for good reason. Let's say you invest in a dividend-paying stock that has a 3% yield. If you reinvest those dividends, over time, you're not just earning returns on your original investment, but also on the dividends you've reinvested. This snowball effect can significantly boost your portfolio's value over the long term. The key here is patience. Compounding takes time, but the longer you stay invested and reinvest your dividends, the bigger your returns will be. This is why starting in 2024, reinvesting dividends should be a cornerstone of your investment strategy. Finally, if I were starting to invest in 2024, I'd make sure to never stop learning. The world of investing is always changing, and the more you educate yourself, the better equipped you'll be to make smart decisions. I recommend regularly reading financial news, listening to podcasts, and following trusted voices in the investment community. You don't need to become an expert overnight, but staying informed will help you adapt to changes in the market and take advantage of new opportunities as they arise. There are great resources out there, like The Intelligent Investor by Benjamin Graham or Common Sense on Mutual Funds by John Bogle. These books provide timeless wisdom that can help you understand the principles of long-term investing. There are also podcasts and YouTube channels, like this one, that can keep you updated on the latest trends and strategies. The more you learn, the more confident you'll feel as an investor. And remember, even though investing can seem intimidating at first, It's a lifelong journey. The more knowledge you gain, the more empowered you'll be to grow your wealth in 2024 and beyond. And there you have it. If I were starting to invest in 2024, these are the steps I would take. From building a solid financial foundation to diversifying your portfolio, staying consistent, and continuing to learn, these strategies will help you succeed in the stock market for the long term. If you found this video helpful, be sure to hit the like button, subscribe to the channel, and leave a comment below with any questions or tips you'd like to share. And remember, investing is a journey, not a sprint. Stay patient, stay consistent, and most importantly, stay invested. Thanks for watching, and I'll see you in the next video.